Good afternoon, ladies and gentlemen. Welcome to the ITACONIX PLC analyst meeting for the final results for the year ended 31st of December. I do apologise about the short delay in starting today's presentation. Throughout this presentation, analysts will be in listen-only mode. Questions are encouraged. It can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in a question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. I'd also like to remind you that this presentation is being recorded. I'd now like to hand you over to John Short, CEO, and Laura Denner, CFO of ITACONIX PLC. Good afternoon.
Good afternoon. We're very excited to be here. It's an exciting day to be able to talk about our 2020 results. Which was really a tremendous year for us. Regards to our, I just need to advance the slide.
I can just do that for you, John.
Yeah, you can advance the slide, that'd be great. This is a standard disclaimer in terms of anything we say today. If you could advance the slide. Okay. I am John Shaw, the CEO, and Laura Denner is joining me. She's our CFO. We're going to review kind of polymers for better living, our financial results, how we play into the ingredient wish list that our customers have in the marketplace, our position on sustainability, go through some product updates, operational progress, some global factors that we're facing, and then Laura will take us through the financials and discuss the outlook. You could advance it, that'd be great. What we are about is polymers for better living. We make key ingredients that are to go into disruptive products that meet emerging and current new buying behaviors. From that, we were experiencing major growth and tremendous revenue momentum towards a very high revenue potential, and we're in a strong cash position after completing $2.2 million fundraise and being on the path towards profitability on it. Next. Polymers for better living. What we are is we make plant polymers that come from plant-based carbon that are key ingredients in a range of consumer products, a new generation emerging based on the performance, cost, and sustainability of the ingredients that we have. Our current focus is on a 600 million pound market potential in detergents, odor control, and personal care applications. Within those areas, we have formulations that customers are using out there right now where we've been validated as a key ingredient in about 60% of the types of formulas that we need to get into. So we have demonstrated performance in there. We are working on global scaling, both directly ourselves and with some major partners with Nouryon and Croda in the personal care and odor control space. And we also are highly valuable as advanced sustainable materials that's enabling us to play a major role in the emerging low carbon economy on it. Advance, please. Let's get to the real high points here, which is just a tremendous year on our financial side of it. On the revenue side of it, if you could advance it one here. On revenues and gross profits, we reached almost 3.3 million off of 1.3 million last year. That's 156% growth, strong growth, and it's really across all of our product areas, all of our application areas. So major advancement on our commercial progress across that. That did translate through into equal growth on our gross profit side, meaning that we were able to maintain our overall gross profit margins across our product lines for strong profitability growth to translate it through. Next. What that means in terms of how it dropped to the bottom line in our cash position, Laura and I and the whole team are keep very steady oversight over both our operating expenses and our working capital and capital expenditure side. So on the operating expenses side, we were able to reduce our EBITDA losses by 1.5 million down to now we're below $1 million in adjusted EBITDA loss on it. Cash from operations in terms of when you add back in working capital requirements, the capital spending needs, we drop that down to a little bit less than 1.2 million in cash required for the operations. What that resulted is for our net cash at the end of the year was close to about $1.5 million in net cash at the end of the year. So really a tremendous transformative year for us in terms of our financial performance around high revenue growth and translating that through into profits and reduced cash use on it. Next, please. The key part for us is that we're advancing in terms of meeting our customers' desires for what they want going into their end products. When you think about the customers that we're dealing with on the consumer product side, they come up with these beautiful wish lists of what they would like their ingredients to do. They'd like new performance claim. They'd like to reduce the end product cost. They'd like to have more compact formulations, be higher bio-based content, excellent human safety, non-GMO. They'd like it to be meet certification requirements, not have certain ingredients in it, and that's really what we play into. Is they have an idea of how they want to advance their consumer product, look for ingredients to do it, and that's what we fit into. As we describe in the bottom part of it, that process usually involves we send them a sample, they evaluate it, they evaluate in the formulation gets optimized, and then it gets launched out and we get a purchase order out of it. What's that's translated into in terms of revenue growth over the last 3 years is growth across both our personal care products, which would cover both hairstyling and certain parts of our odor control business, and home care and industrial. So you can see that we had nice growth across both sectors in 2020 on it, and continued to grow there. Next slide, please. The other key part for us is our role with both our customers and our mission around climate change. And what we do in both the nature of the materials that we use and the products that we go into is we have a tremendous potential to make contributions to the low carbon economy. Just go through it just a little bit, which is, remember there's CO2, carbon dioxide that's in the atmosphere. That's a key concern of reducing the CO2. That CO2 is actually captured by plants. Where in our situation is corn that's used to generate the sugars that go into the itaconic acid fermentation. So the carbon dioxide being captured by the plants turned into carbon. That plant-based carbon comes into the fermentation process as a sugar that is the carbon that goes into the itaconic acid. We buy itaconic acid on the open market, and we bring it here to our facility in New Hampshire to run it through our patented process. So the carbon that's in our polymers is plant-based carbon that started as carbon dioxide in the atmosphere. So through our production process that we run here to create our polymers, we create products that are ingredients that go into consumer products. Those consumer products get used and disposed of primarily into landfills and into sewage treatment systems. And those they then sit there. And depending on our product, they do eventually degrade, some faster, some slower, after the consumer products are disposed. And once they degrade, they then release, and you're releasing the carbon dioxide, the carbon ultimately back into the atmosphere. So in this circular process, we have a key role here in terms of capturing and sequestering carbon along the way, which is a very important trend, high priority in terms of having a low carbon economy to address climate change and greenhouse gas buildup. So very important role that we have both with our current products and our future products. Next slide. When you look across our product line right now, we are key ingredients in disruptive products, but they are plant-based materials. So let's kind of go through where we stand on each one of our products. We have 4 products that we sell right now into the detergent area: ITACONIX DSP2K, ITACONIX TSI, ITACONIX CHT, and Velasoft. They vary between being 100% plant-based carbon, and then our TSI and CHT are copolymers, so they use a little bit some other materials other than itaconic acid in it, still have very high plant-based carbon. In odor control, the Zinador, which is the home care product sold through Croda, and then VelaFresh, which we sell directly, those are 80 to 100% plant-based carbon. And then in the hair and skincare side, the product we make for Nourion, Amaze SP, that's 100% plant-based carbon. So anytime you're using plant-based carbon, you're helping the low carbon economy with decarbonization. But on top of that, we do contribute to the energy efficiency, both by the low amount of energy that we use in our process and the low amount of capital equipment that required in our process in it. And then even further, particularly in our detergent areas, we allow for compact, lighter products. So a detergent pod may be 3 or 4 grams lighter than what it's competing against. And even within that is tremendous carbon savings, carbon emission savings, greenhouse gas emission savings, which we've actually highlighted in our annual report. We won't go through it here, but please do take a look at it. So this is how our products by area contribute as plant-based materials into the low carbon economy. Next slide, please. I'll go through a little bit of progress of where we are with each product. Our lead one right now is ITACONIX TSI 322. We launched that as our latest detergent polymer a little bit over a year ago, and have gained tremendous traction in that through the second half of last year, primarily around the launch of a major brand that was here in North America, that is now in shelves across North America at major retailers. That was related to our agreement with New Wave and the supply agreement, the formulation licensing agreement and contract we have with them with their use. That drove a tremendous amount of our growth last year. That being said, once you have a success on the market, it keeps rolling through into other formulations. So with the new position that we have with the value of TSI in an automatic dish detergent, we are picking up additional brands at a fairly good rate. Last year, we got into a specialty and private label brands, reformulated the detergents to capture the performance and cost advantages of TSI, and we really were able to bring down the cost of the formulas of it. And then very exciting for us is that in the initial part of the end of Q4, we got the initial revenues for a new green dishwashing detergent that was just launched back in January by another major national brand here. So we have tremendous momentum going across a number of brands, and we have more brands starting in the coming months. Between now and into August and September, we are picking up additional brands, a little bit smaller brands, but all of those are highly valuable in it. In terms of odor neutralization, Zinador going through Croda is doing very well. We're continuing to see great sales there. With particularly a market leader is expanding the use of Zinador across its product line over the next 18 to 24 months after successful trials. Interesting is that why you like to work with partners is that Croda we picked them because they have a very broad sensory technology platform, and they are rolling out a new product called Effigen which is a probiotic for odor control. And they are actually co-promoting Zinodor with their new probiotic odor control agent, as you can see here. And they actually work very well together, where Zinodor has a certain function and the probiotic has a particular function in odor control, and they do it together. So we expect to see continued great progress working with Croda. Next. In the other area of odor controls, we work directly in personal care, where we sell both directly and through our some selective distributors outside of home care. And we've had initial success with specialty brands in the aluminum-free underarm deodorant area. And one of our key areas of emphasis this year is expanding off into additional broader applications in the hygiene area with this product. Next. Amaze SP is the hairstyling product for weightless hairstyling. You really can't get there any other way other than using our polymer. And even in the midst of a fairly significant downturn in certain segments of the personal care market during COVID-19, we still had excellent growth in sales for Amaze SP as more and more brands started picking up the use of the product, and then the brands that were out there were getting greater success in the marketplace. Next. An area that we announced last year was Bioasterisks, which is our line of bio-based functional additives. We are developing a broader product line, which I'll speak about a little bit later on it, for more products, more applications, into some much higher revenue potential applications like paints and coatings, adhesives, areas like that. We do have initial trials out as a specialty additive and in biodegradable films and packaging. They are progressing. We are seeing some value there, but we do not expect significant revenues on that for at least another 18 months. But that is a slow development process. But there are certain functions that we can add into those packaging that are valuable. Next. So in terms of operational progress, we are advancing disruptive consumer products across all of our product lines, particularly high in terms of revenue growth last year was our new detergent products in North America. We are increasing the demand for weightless hairstyling, broader adoption in odor control and home cares, and we have initial sales into underarm deodorants and actually shampoos also for odor control in the personal care and pet side of it. Operationally, we were able to, in a very high growth year, fulfill all of our customer orders during steep demand growth. We did go to 24-hour production. We added a full production team. So we now have the ability to run 24 hours a day to keep up with demand. As we announced in late 2020 and early 2021, we've added a vice president of operations and a vice president of marketing and sales, which now gives us a full executive team with our CTO, Dr. Odor Durant, Laura Denner, our CFO, and myself. The key benefit for immediately for having a full executive team is that Odor Durant and myself, who were the original co-founders of ITACONIX Corporation, are really have some time to focus on additional revenue growth opportunities in some new application areas and new chemistry areas. Also significant, we did terminate our UK facility lease, which was a savings for us and kind of completed any of the costs we had to our restructuring in 2018. Regarding funding, we did reduce our operating cash requirements significantly. We completed our $2.2 million fundraise and had $1.4 million in cash as of December 31. Next. Regarding global factors that we're seeing, obviously we do have the COVID-19 pandemic. We were able to continue operations throughout it with the health and safety of our employees first and foremost. We had measures in place to keep everyone safe, and we did continue operation. We did have a favorable market for launching new dishwashing detergents That means these projects were in the pipeline. They were already planned. We were already going to have a good year, regardless of the pandemic. But they were favorable market conditions for launching the new ones. It did, because of the closing of many of of our customers' formulation labs were closed. The staffing was limited in those labs. There was a high level of interest in ready-to-use end product formulations, and we were fortunate to have a number of those available, particularly in the detergent market, to be able to get our customers out on the market with new formulations, even though their labs had limited capacity. We are starting to see some secondary effects in the supply chains through delays and shortages and some cost increases related to COVID-19. Particularly here, some delays in shipping coming out of Asia, higher cost of shipping coming out of Asia, some shortages of supplies, not for us. We're fine on the raw material side of it, but when we go into a detergent, you have to make sure all the other components are there. So certain elements of the raw materials for surfactants have been a little bit slower in arriving, and also some of the costs have gone up. So we are starting to see some secondary effects from the pandemic on it. Low carbon economy, with the new administration here in the United States, a new emphasis clearly on climate change, and we're seeing that translating into new consumer urgency on climate change, and really some changes in favorable changes in terms of buying behavior around measures that can address climate change. In terms of global disruptions, beyond just the straight COVID-19, we have had some material shortage and price increases caused by delays. As I said, some of it is out of COVID-19 related to Asia, but we've also had some serious plant shutdowns related to weather and some operating issues at some major plants, not related to the production of our product, but related to other components that go into detergents. So when Texas froze over, most of the surfactants that are used in the United States a huge percentage of them come out of the Texas area, the petrochemical complex in the Texas area, and those all froze. So there was a force majeure on hundreds of products that has delayed production of some detergents. That's coming back now, but there was a delay. And then actually the lower US dollar has affected some in terms of some of the raw material costs coming in. It's just a different world. I'm sure you guys are seeing it elsewhere. It is a different world that's emerging after COVID-19. We're keeping a close eye on it. Brexit did happen, which was interesting to us. Our original merger with Revolimer happened in 2016, 3 days before the Brexit vote. So we've been able to go through the whole process. For us, no major effect on terms of our revenues or operations at this point. We don't have large revenues based in the UK at this point, nor do we have operations there. The main effect is that there is a separation of the EU and the UK chemical approvals and chemical inventories that have required some additional regulatory efforts on it. Laura's going to take you through our great financial statements.
Yeah, so as John was pointing out, we had a wonderful year this year. Year over year, we saw 155% growth in our revenues. How that really broke down was that, half over half, our first half was about 1.1 million. Our second half was about 2.2 million. So we nearly doubled our first half in revenues just in this year. Gross profit has maintained a pretty attractive margin over the last 3 halves or the last 18 months. We've stayed in the mid 30s to high 30% growth in gross profits, which means that, we were able to maintain the nice margin that we had. As we move down into the administrative expenses, last year, 2019, was really our first full year as the new ITACONIX structure. We had reduced costs down to our $3.4 million. With COVID, we were able to squeeze an additional cost savings out of additional $800,000. So with that, we expect some costs to go up. As John was talking about, we brought on a full executive team, so we're really positioned to grow. So we see that as a really positive aspect. Next, as we get down to exceptional items, one thing I'd like to point out is our contingent consideration. This was a liability brought on during the merger that we had, and we do actually expect to have a payout this year to the former ITACONIX shareholders because we have seen that nice growth in revenue. So we will be doing that payout in 2021. If you want to go to the next slide. One thing we like to talk about is our low CapEx. As you can see, we've maintained a low capital expenditures over the last 2 years. This has really just been a change in depreciation. We've not had any significant CapEx expenditures over the last year. As you can see, as we move down into our current assets, we've had a substantial growth in inventories, and that really correlates to the increase in our revenue growth. Our cash balance was very strong at year end. We were able to successfully complete our $2.2 million fundraise and able to really put that cash to work through our increase in revenues, our increase in working capital. So we saw about a $1 million increase in our working capital, which just allows us to take that money that we raised back in July and really put it to work for the company. We did have, just of note, we had a note payable of $183. That was money that we were able to get from the United States government through the SBA PPP loan, which is the Paycheck Protection Program that they put in place for COVID-19, which allowed us to support our employees through the pandemic. Next slide. As you can see, our cash flows from operating, we were at $1.8 million in 2019. We were able to, through the work of the team here, we were able to bring that down to $1.2 million. So we're seeing that our operating cash is coming down substantially as we continue to grow the business. You can see down in our financing activities that we had that $2.2 million fundraise, and we were able to secure that debt. So overall, an amazing year for the company. We've seen strong growth, and we'll continue in the coming year.
So for our outlook, first we have our plant-based ingredients platform, which goes far beyond the products that we have right now. It will find increasing opportunities in the low carbon economy. That's one of the efforts that particularly Yvonne Durant and myself are starting to focus on, is the next revenue horizon and opportunities for a vast inventory of proprietary chemistries that we have, and how that applies into emerging opportunities of it. All of that, though, gets built on an expanding base of sticky, recurring revenues. They have a foundation for us of continued revenue growth. As you're in these formulations and you just keep stacking them up, they keep turning into nice, high-valued, almost annuities to keep building these recurring revenues on. And it's really going to help drive us towards achieving a kind of sustained profitability in the coming years on it. As we had success last year, one of the things that's wonderful part of for the value that we bring to formulations is success as a key ingredient and a disruptive product, is that it just breeds more success. As brands see new brands on the market that have new claims, good cost positions, they trace down to see what ingredients are being used, and you get more phone calls. So to us in the detergent area, some of the hard work over the last 4 or 5 years really came to fruition last year, and it's going to continue to come this year. We're not going to win all of them, but we're continue to get a high share of new detergent formulations in certain segments of it. That's giving us commercial momentum in 2020 is progressing into 2021 with additional brand usage, particularly in North America, and some emerging opportunities in Europe. We are going to see some secondary effects of COVID-19. We've already seen some of them in terms of some uncertainties and disruptions in the supply chains. Not as much, again, for us as it is for other ingredients that are going into the detergents. So if the surfactants don't arrive at our customer's blending facility, that means they're not blending our product in either. So we've seen some delays there. We think most of those will get sorted out, but there have been some delays. And then with our full executive team, with our capabilities to run 24 hours a day, we really have the capabilities in place to safely meet any demand growth that we see in the foreseeable future on it. So in summary, we just a tremendous year in terms of actually achieving major revenue growth. We strengthened our balance sheet. We exited the year with strong cash and working capital position. We are getting higher traction as an ingredient delivering performance, cost, and sustainability. We have excellent low carbon metrics for our customers and ESG investing on it around decarbonization, the low carbon economy. Our existing products have excellent growth and demand across all applications and all products, with additional growth in the pipeline in all of them. That's giving us a very clear roadmap to profitability, and the potential a little bit as we did expand and take on some additional costs to have a full executive team later this year, in the beginning of this year, to create the opportunity, particularly for Dr. Durant and myself, to focus on new horizons there. So really some large potential for both our current and new products, and in a great position from our operations to be able to deliver on all of these. So really that kind of concludes our fixed presentation on it, of what really was a tremendous year for us.
Fantastic. John, Laura, thank you very much for your presentation. I'd now like to open the floor to questions. And to submit a question, please just click on the Q&A tab on the right-hand corner of your screen, type in your question and press send. I'd also like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, will be able to be accessed via your investor dashboard on the Investor Meet Company platform. But just while we'll see the questions start to pop through, I'll perhaps hand back to John and Laura. Just if you can click on that Q&A tab, guys, and just start to see the questions come through and answer where appropriate to do so. Thank you.
Great. Hey, Gareth. Gareth has a question of all the various different routes for growth. Which do you see generating news flow first, and which do you see as the largest long-term opportunity? I wish our customers would let us generate more news flow out of the successes that we have. They are very sensitive in terms of us mentioning anything about how our ingredients are used as critical ingredients in their products. They're highly protective of it, so we are really limited in terms of all the things we'd like to do, be able to talk about. I must say, we note that the outside world is pretty good at tracking down all the products that we actually are in it. But I think some of the news flow may come out of some of the new chemistries that we have coming out. I think as Bioasterisks advances, we expect some news flow to come out of that in terms of new revenues potentials. In terms of actual new revenues that come out of our existing one, again, these are generally not contracts; they're purchase orders that we get, and we don't have fixed contracts to be able to say, great, here's a take or pay for the next 3 years for £3 million or something like that. So those are just a steady. The nature of the specialty chemicals business, it's a steady flow of purchase orders from a highly diverse base of it. And that's really one of the beauties of what we're trying to create as a company is a diverse base of uses across a wide range of products on it. In terms of seeing the largest long-term opportunity, I think that's the work that Yvonne and I are doing right now over the next 3 to 6 months in terms of we know what our chemistries can do. You need to go out into the marketplace to see how those align with urgent customer unmet needs. And we have some work to do there. But again, we're starting from a base of we can pretty much make any polymer that's made from acrylic acid. Acrylic acid is a $20 billion market. We have at least, our chemistries address at least $3 to $4 billion of the applications that those acrylates go into across paints and coatings, super absorbents, and water-soluble polymers. So we have some work to do in the coming 6 months to figure out what's the next one to add into it, but we have a great range of chemistries to do that with. David asks, is the $1 million reduction in overheads a full year effect, and what additional costs have been added in since then for the full management team? So what would the current overhead run rate be?
So I don't know if you were referring to the reduction in our administrative expenses of about $800,000 year over year. That was really COVID-19 savings that we did some cost reductions. We're really expecting our cost base to be more towards that 2019 cost base or a little bit higher potentially with the additional headcount.
And that was a decision we made to add in some expense. One, we were a little lean, quite lean, that Laura, Yvonne, and I could only do so much, and we really thought we were cutting off some major revenue opportunities and putting the delivery of our pipeline that we have at risk without adding back in some of those resources on it. But really at that, we're now at a steady state in terms of our cost base on it. From James Tetley, what can you say about the early reception of the recent customer brand launches? Are there initial sales in line for pre-launch expectations? Do you expect volumes to continue to ramp up on these launches? So the large brand that we had launched last year, that has continued to have strong demand. It's still making its way into more retail outlets in North America. So when a brand launches, they usually start in a very narrow set of retail outlets. They try to get into some of the major grocery stores here, and then they slowly build out into additional retail outlets on it. So for the major launch last year, they're still building out into more retailers. Actually, it's actually hard for us in the Northeast. Sometimes it's hard to find our own products in some of the major retailers around here. So there's still, we expect good growth of the brand that was launched last year from bigger penetration at the retailer. The same's true for the major launch that happened in January of a major green brand. That is still going to build throughout the next 18 months as they get into more retail outlets on it. They started with in a good area in a good number of retailers. What's nice about major brands is you get in there. They can use their brand power to get into more retailers. We do have, this is where private label's nice because you have an installed base of retailers. So we do expect our private label base to increase this year also. So really within our existing base of business, that will continue to ramp up. And then we are adding on new brands that as they get launched at relatively small volumes, nice, but relatively small volumes, those continue to progress. So there's already inertia for growth built into the launches that we already have. And that's really true across all of it. I know that some of our personal care growth in Europe, particularly, came from brands that were launched like 2 years ago that finally are gaining very rapid demand growth in the end market on it. So you get into a formulation. That formulation gets launched as a consumer product, and if that product succeeds, you get to follow that growth pattern up on it. So there's a lot of inertia already built into it. That being said, I think it's a good time to comment that the second half of the year is always a bigger half for us. The fourth quarter in particularly is strong because a lot of these product launches come in the first quarter. That's when retailers, particularly in North America, reset their shelves right after Christmas. So usually launches get onto the shelf around February. And if you're going to be on shelf in February, that means that we're delivering product in October, November, and December to the production facilities to get them produced and then through distribution out there. So the second half for us typically is much stronger than the first half. January and February usually are lighter months annually for us on it. That being said, we have started the year dramatically ahead of last year. Our first quarter was far ahead of our first quarter last year. We do not expect to replicate the second half of last year in the first half. That's just not the way the business works. It'll be a very good half. It'll be ahead of last year, but we do not expect it necessarily to be replicating that. But we will be carrying that inertia into the second half of next year, into the second half of the year on it. That's just the nature of the business on it.
David B., you mentioned that you flexed up manufacturing capacity to meet the additional demand last year. What is the current level of capacity utilization, and what is the strategy to scale up the supply chain? I think our current capacity, we did move to a 24-hour shift, and that was really to realize the most efficient production process. So once we keep the process running on a continual process, we're able to really recapture as much material usage as possible. With that said, we removed some of the production days, so we have significant capacity still available here in the plant. I would say of total hours in the year, we're probably at about 50% utilization right now just to meet our current demand. So we have plenty of capacity to scale up the facility here in New Hampshire to meet any kind of customer demand. That would be on the high side of where our current capacity is or our current utilization is. We can continue to expand in this facility to meet our future growth, our future revenue. We've talked about some small capital expenditures to double the capacity. When we get up to full utilization of this plant, we can double the capacity still at that point with a second production line to run more pounds per hour off of our production plant.
Yeah. So we think of it as if we were running full out, we would have 4 production crews. We have 2 production crews right now, and then we can double our capacity fairly easily for each of those. So overall, we're running at like 20 to 25% of our capacity. And that being said, one of the reasons we brought on a VP of operations with Helen Kane, who's a highly experienced specialty chemicals operator, is also to eke out yield improvements and rate improvements through lots of tinkering and optimizing the line, which will have an increased focus on that. But we're in excellent shape in terms of meeting any foreseeable demand in a very cost-effective manner without using much cash.
Thank you, John. Laura, I think you've answered all the questions that we've had through so far, and perhaps we'll just give analysts just a couple more minutes, just if there are any further questions. Otherwise, John, perhaps I'll ask you for a few final words just to wrap up, please.
Again, it's just a tremendous year, transformational year for us to that the years of effort that we put into building a customer pipeline has come to fruition. That in terms of both the actual volumes that have come through and the breadth of products where we are the key ingredient in a disruptive product, and really across a broad base. So to see what's most pleasing for us and for Laura, myself, and particularly Dr. Durant, is just to see the 6 or 7, 8 years worth of work to develop this pipeline finally coming to fruition on it. It's just personally satisfying, but also it's nice to have these kind of numbers to be in a totally different world in terms of being on the path towards profitability on it. So that's pleasing. We're not satisfied with that. When you think back at when Dr. Durant and I first met in 2008, and what we spent hours talking about the potential of itaconic acid, we're just beginning to tap into some of the long-term potential for itaconic acid. There are massive new horizons when you go back to that $20 billion acrylate market and the $3 to $4 billion that's probably accessible with our technologies. Massive opportunities ahead, and we're really excited to have the team in place to be able to pursue those at the same time that we have tremendous inertia in our existing business.
John, Laura, thank you again for updating analysts today. On behalf of the management team of ITACONIX PLC, we'd like to thank you very much for attending today's session. That concludes today's event. Thank you very much and good afternoon.